The gold price is lying and the spread is telling the truth, because a declassification switch quietly snapped the paper market, could ask clean connection to physical metal, and most people don't even know what number they're arguing about. They're chanting Executive Order 12391 like it's a single hammer blow, while the real mechanism sits in the boring part of the system, how gold bars get labeled, cleared, and deemed exempt or tariff eligible inside the plumbing. That's the conflict. The headline crowd wants a simple villain, while the market is dealing with a logistical and legal bottleneck that forces real flows, not opinions. And if you stay with me, you're going to walk away with 3 things you can actually use this week. The one spread that matters more than spot the levels that define whether this move is a controlled retest or a squeeze, and the checklist that tells you when the setup is breaking before the chart makes it obvious. Because here, what just happened in plain market language. Gold didn't merely go up. Gold got repriced through a choke point, and choke points don't negotiate. They don't care about your thesis. They don't care about your timeline. They care about what can be delivered, where, under which rules, and at what cost. That's where the real pressure starts. If you've watched gold in the last year, you've seen the big, clean narrative, geopolitical stress, rate expectations, central banks buying, and investors trying to hedge against the idea that fiscal discipline is a fairy tale. Fine. That story explains demand. But it doesn't explain why, at certain moments, the market starts behaving like 2 different gold prices exist at once, one on a screen and one in a vault. And when those 2 prices diverge, the screen price can stay calm right up until the moment it can't. But that's not the part that matters. The part that matters is this. The market is trading the classification pathway, not the gossip. Executive Order 12391 is being used like a symbol for the whole episode. But what's actually tradable is the chain reaction. Tariff frameworks, customs interpretations, and regulatory categories that decide whether a bar is treated like an exempt investment article or like a tariff-exposed industrial input. That sounds technical. It is technical. And it's exactly why it moves real metal. Think of it like a shipping label in a world where shipping labels determine taxes, delays, and legal risk. If you're a dealer, a bank, a refiner, or a fund that needs physical optionality, you don't get paid for being brave. You get paid for being right. So when the label becomes uncertain, the entire system reflexively pays for insurance. It pays for optionality. It pays for, I want it here in this form right now. And that payment shows up first in spreads and inventories, not in the pretty spot chart you see on your phone. The next detail is what flips the whole setup. Let's talk about the classified rule without the mystique. Classified doesn't mean secret. In this context, it means which box a gold bar falls into for the purposes of trade and regulation. In the US, that's tied to tariff schedules and harmonized tariff schedule codes. In other jurisdictions, you'd have got a parallel question. Is this bar treated as an article that WES exempt or a substance that triggers regulatory handling? Those aren't philosophical debates. They are gates, and gates create premiums. Here's the mechanism that makes this explosive. Gold is the same element, but the market treats different forms of gold as different products when rules demand it. Kilobars, 100-ounce bars, coins, doré, recycled feedstock, same family, different paperwork. Add one more constraint. Certain venues and contracts want very specific deliverable forms. Now add a policy fog that changes whether a common bar format is safe to ship. The system doesn't wait for a press conference. The system reprices the risk immediately, because if the risk is, I might be wrong and eat a massive tariff, the correct trade is to stop shipping until you know. And if enough people stop shipping, you get a localized shortage regardless of global supply. And that's how paper gold breaks on a physical detail. So how do you actually see it? You don't look at the headline. You look at the spread between hubs, especially the New York versus London tension. When New York trades at a premium to London, the market is screaming that converting one form of gold exposure into another isn't frictionless anymore. In a healthy system, arbitrage compresses that gap. If New York gets too expensive, metal moves, the spread tightens, and everyone pretends it was just temporary. But if the spread widens and stays wide, it's telling you the RB pipe is kinked. And if the RB pipe is kinked, the market structure starts doing something dangerous. It starts paying people to hoard deliverable metal in the right place. That's where the real fracture begins. Now, let's get concrete, because the metals crowd doesn't respect vibes. Over the past year, there have been repeated moments where traders moved large quantities of gold from London and Switzerland into US vaults specifically to satisfy COMEX delivery optionality and to hedge against the risk that policy changes could make shipping more expensive or more complicated later. That flow matters because London is the global center of bullion liquidity. Unallocated accounts, local London settlement, the vault ecosystem. Drain liquidity there and you don't just change inventory, you change the speed of the market. Liquidity thins, spreads widen. The paper system becomes more sensitive to shocks. And that sensitivity is exactly what turns a classification rumor into a tradable event. But here's the twist. In 2025, the US implemented a reciprocal tariff framework under a broader trade posture. Then came clarifications, memoranda, and guidance that spelled out exceptions in specific code categories. That is how this stuff works in real life. First a broad policy, then pages of exceptions, then agency interpretation, then market panic when interpretation drifts, then a clarification that markets treat like an admission. The rules were tradable the whole time. And that's why when people shout EO 14391, what they were really reacting to is the ecosystem of documentation, an interpretation that can change the economics of a bar overnight. Because if this one level breaks, the math changes. Here's how the math changes. If you're a bank making markets in futures and swaps, you don't want to be short deliverable optionality when the cost of sourcing deliverable metal spikes. If you're short and you've been using I can always buy it later as your comfort blanket, a classification shock tears that blanket in half. Suddenly, later has a tariff risk premium. Later has a shipment delay premium. Later has a compliance uncertainty premium. So instead of waiting, you pull metal forward. You rehome it. You put it where it's most useful. And that shows up as a surge in inventories in the deliverable ecosystem. This is the part that confuses people. Inventories can rise dramatically without any new gold being mined, because the gold isn't new. It's being repositioned for optionality. It's the same metal playing musical chairs between vault systems because the rules decide which chair keeps you safe. That's not conspiracy. That's incentives. That's risk management. And when enough large players do it at once, you get the illusion of abundance in one place and scarcity in another, and that's where the market gets jumpy. Now, layer on the why now, because timing is everything. We are in early January. Liquidity is thinner than people admit, especially after year-end positioning, tax-related behavior, and the reset of calendar-based risk budgets. Some funds rebalance at month-end, quarter-end, year-end. Some dealers manage options books around specific expiries. Some physical players plan deliveries and shipments on their own calendar windows. So when you get to policy uncertainty colliding with a calendar that forces decisions, the market does what it always does. It moves first, explains later. The calendar is the catalyst. And then you get the second force, the one that makes this cinematic. Options and dealer hedging. I'm not going to drown you in Greek letters, but you need the concept because it changes how squeezes happen. When a lot of options are clustered around certain strike levels, the dealers who sold those options hedge their exposure dynamically. As price approaches a heavily trafficked strike area, the hedging can become reflexive, buying into strength, selling into weakness, depending on where the option's positioning sits. That doesn't cause the fundamental move, but it can amplify it, especially when liquidity is thin and everyone is staring at the same levels. So if gold is pressing toward a prior high zone, the mechanical hedging flow can create that feeling of inevitability, and that's exactly when the market tries to emotionally manipulate you. Because volatility is a weapon. The market will use fast downdrafts and ugly wicks to make you abandon the right thesis at the wrong time. It will make you feel stupid for being early, and then it will make you feel greedy for being right. It will do both, and it can do both in the same week. That's not a moral statement. That's just how a liquid market shakes out weak risk management. Keep that in your pocket, because we were going to come back to it when we talk about what to watch next week. Now, let us address the piece that is getting wrapped in the word classified and sold as a single rule. The most tradable version of this story was never gold is banned or gold is tariffed in some absolute sense. The tradable story was the uncertainty about whether common Bullion bar formats could be swept into tariff-eligible classifications under certain country-specific frameworks, depending on how customs interpreted the codes. That uncertainty is enough, because when you can't price the tail risk, you stop the flow. Refiners pause shipments. Banks and dealers hedge by pulling inventory forward. Vault stocks move, and the spread tells the truth. You've seen this pattern before if you were watching in 2020 when logistics froze and the spread between paper and physical blew out. Back then it was planes, lockdowns, and movement restrictions. This time it's paperwork and policy risk. Different trigger. Same physics. If you cannot move the metal, the market pays for immediacy. If you cannot confidently label the metal, the market pays for legal certainty. Either way, the cost shows up as a premium. And that's not a theory. That's a mechanism. Now, snap back to right now price context, because you need the tape. Gold had a monster 2025, rising sharply and setting late year highs. It also started 2026 with big daily moves tied to geopolitical headlines and macro expectations, pushing spot into the mid 4,400 units per ounce and keeping futures active with robust participation. That matters because it tells you something important. This is not a sleepy, retail-only market. Open interest and volume are meaningful. That means there are real books to manage, real hedges to maintain, and real forced behavior when price moves. And forced behavior is what turns a thesis into a squeeze. But that's not the part that matters. The part that matters is the hidden detail. The market isn't T-fracturing because someone discovered a secret executive order. It's fracturing because classification is a two-sided trap. On one side, you have U.S. trade policy frameworks and HTS code interpretation that can temporarily put a common bar format in the wrong bucket. Wrong bucket means potential tariffs and legal exposure. On the other side, you have regulatory classifications in other jurisdictions that can treat the same bar as an exempt article in one use case and a regulated substance in another, depending on whether it's investment storage or manufacturing feedstock. That means a bar's identity is not purely chemical, it's contextual. And contextual identity is exactly what breaks simple arbitrage. Because arbitrage depends on sameness. If New York and London are truly trading the same thing, the spread closes. If they are trading different versions of gold, different deliverability, different compliance risk, different shipping economics, the spread can persist. The persistence is the fracture, not the spot chart. And once you accept that, the entire story changes. You stop asking, why is gold up? And you start asking, where is gold most valuable right now and why? That's a better question. So let's do a quick calculation because it makes it real. If the premium between New York deliverable pricing and London spot goes from barely noticeable to tens of dollars, that doesn't sound huge compared to a $4,400 ounce price. But for a 100-ounce COMEX contract, a $20 premium is $2,000 per contract. A $50 premium is $5,000 per contract. Multiply that across thousands of contracts, and you're looking at serious money, serious incentives, and serious pressure to source and position metal. That's why inventory suddenly moves like it's on fire. The spread isn't trivia, it's the incentive system talking. And that's where the real pressure starts. Now, let's talk about who gets forced to do what. Well, because every technical concept has to cash out into behavior. When spreads widen, arbitrage desks try to capture the gap by moving metal or using exchange for physical mechanisms to shift exposure between venues. But if there's uncertainty around shipping, classification, or timing, the arb is no longer free money. It becomes balance sheet intensive, operationally complex, and legally risky. That means fewer players do it. That means the spread can stay wider, longer, and while it stays wider, the market is effectively paying a premium for deliverability and certainty. At the same time, future shorts and market makers who normally lean on the assumption that they can source metal if needed start to reduce that risk. They buy back shorts, they increase hedges, they pull inventory into deliverable vaults. Some do it proactively, some do it because risk managers demand it, some do it because margin models punish them when volatility rises. And this is where the positioning and margin spiral can start. A move forces hedges, hedges push the move, volatility rises, margin increases, weaker hands reduce risk, and that reduction of risk itself becomes buying pressure. It doesn't have to be dramatic to be real, it just has to be enough. And if you've ever watched a metals market in stress, you know enough can happen fast. Now, let's address the institutional narrative without turning this into a cartoon. Are there incentives for large institutions to prefer orderly markets? Yes. Are there incentives for policymakers to avoid admitting that rules are creating volatility? Yes. Are there incentives for dealers to talk down plumbing issues because it sounds destabilizing? Absolutely. But the market doesn't need a villain, it only needs a constraint. The constraint is classification, uncertainty colliding with deliverable market structure. That's the mechanism. That's enough. The next detail is what flips the whole setup. The flip is this. When you finally get a clarification or an update that explicitly exempts certain gold products under certain codes, especially for aligned partner countries, you don't automatically go back to normal. Because the market remembers. The market prices the risk that interpretation could drift again, that an exception could be narrowed, that enforcement could vary, that the next policy headline could reopen the wound. In other words, even when you patch the leak, the insurance premium doesn't instantly disappear. It can fade, it can normalize, but it often lingers as a volatility regime. And that's why, even after official updates, the market can stay jumpy, spreads can flare intermittently, and the physical vs. paper tension can remain a live wire. So what does this mean for you right now, this week? It means you need a different dashboard than the average chart watcher. Spot price is not useless, but it's late. It's the last place the stress shows up. The first places are the premium between hubs, the futures curve shape, and the warehouse inventory behavior and deliverable systems. Let's break those down quickly. 1, the premium. If New York pricing continues to carry an unusual premium versus London, that's a sign the RB pipe is still constrained, either by policy uncertainty, logistics, or balance sheet reluctance. If that premium compresses sharply, it can mean the pipe is clearing and metal is flowing back, which can cool the squeeze dynamics even if gold remains structurally bullish. Compression can be relief, or it can be the calm before a new flare. Watch it like a heartbeat. 2, the curve. In a normal environment, futures often trade with a mild contango, future months slightly above spot, reflecting financing and storage. When near-term metal is suddenly more valuable, or when delivery risk rises, the curve can flatten or invert in places, or the spreads between months can behave oddly. You don't need to be a curve nerd. You just need the intuition. If the market is paying up for now, something is tight. If the market is paying you to wait, the urgency is fading. Because if this one level breaks, the math changes. 3, inventories. When you see rapid accumulation in deliverable warehouses, don't assume it means supply is abundant. It can mean fear is abundant. It can mean people are buying insurance. And when you see sudden outflows, don't assume it means demand is dying. It can mean the ARB has reopened and metal is flowing back to where it S needed, or it can mean someone needed collateral and liquidated. Inventory is behavior, not morality. Read it that way. Now, let's go straight into the 2 scenario lens because this is how you keep your sanity when the market starts playing mind games. Scenario 1 is the controlled pullback and retest. In this scenario, gold remains in an uptrend, but it digests the move. The market bleeds off some froth, spreads calm a bit, and price revisits a prior support shelf before continuing. What would that look like on the tape? It would look like gold failing to immediately reclaim the very top, backing off into the lower to mid 4300s or low 4400s, and then finding buyers that defend the level without panic. The spread dashboard would show compression, the curve would look more normal, and volatility would cool. That would be a trend signal intact noise clearing environment. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the premium stays sticky or flares again, options-related flows amplify the move, and shorts or hedgers get forced to chase. Price doesn't politely retest, it rips, pauses briefly, then rips again. That's where you get the ugly feature of squeezes, gaps, air pockets, and intraday reversals that can make you feel like you're watching a different instrument every hour. And that's exactly when inexperienced participants get emotionally harvested. This scenario can happen even if the fundamental story is unchanged, simply because the market structure gets stressed at the wrong time. The calendar matters. Liquidity matters. And if you're undercapitalized or overleveraged, the market will find you. That's where the real pressure starts. Now, let's talk levels, because you asked for what matters this week, not a lecture. If it stays wide or flares while price pushes higher, that's the squeeze signature. Tightness plus momentum. 3, watch deliverable inventory flows and delivery chatter. You're not hunting exact numbers like a spreadsheet accountant. You're hunting behavior. Are people still moving metal for optionality, or is the urgency fading? 4, watch volatility and options magnets into key levels. If price is hovering around major round numbers or prior highs and the tape gets sticky with fast reversals, that can be dealer hedging and crowded positioning colliding. 5, keep the macro overlay honest. If real rates expectations shift, if the dollar regime changes, if geopolitics injects fresh uncertainty, it can reinforce the bid. But if the market starts pricing higher for longer in a credible way, and risk appetite returns hard, gold can still chop even in a bigger bull regime. Don't confuse not going straight up with broken thesis. Now, I'm going to give you targets, invalidation, and a next week checklist, because that's how you trade the idea without worshiping it. Targets. If gold is holding above the mid 4400s and the premium remains stressed, a retest of the late December high zone in the mid 4500s is the obvious near-term objective. A clean break and hold above that zone opens the door to psychological extension moves, because once a market makes new highs in a tight environment, it doesn't need much fundamental news to keep walking higher. It just needs forced behavior. Invalidation. The bullish fracture thesis weakens if you see sustained spread compression back to normal while price fails to hold key support shelves, combined with inventory normalization and a macro shift that removes urgency. Translation: if the plumbing calms down and the chart loses structure, the squeeze narrative fades and you're back to a more normal macro-driven gold market. Still tradable, but different. Next week checklist. 1, the premium between hubs. 2, the curve behavior. 3, warehouse inventory tone. 4, options magnet behavior near highs. 5, any official clarification that reduces classification risk. 6, whether dips are being bought quickly or sold persistently. That's the dashboard. And here's the final thing I'll say, because this is where people get hurt. The market loves to punish certainty. If you go into this thinking, it must be manipulation, or it must be the executive order, or it must be the perfect squeeze, you're handing the market your emotional steering wheel. The better stance is colder and stronger. Incentives, constraints, flows, and levels. That's how you build trust in your own process. If you're the kind of investor who doesn't want bedtime stories, but also doesn't want to be shaken out by volatility designed to farm your reactions, then stay in this corner of the market with me. Drop a comment with the one metric you're watching, premium, curve, or inventory behavior, so we can compare notes like adults, not like headline addicts, because the gold price might keep lying in the short run. But the spread keeps telling the truth.